Good morning, everyone. I'm Vince Lancy. It is Friday. Gold made new all-time highs yesterday on the print and on the settlement, and it's up another $7 today. Silver is now tracking it, getting on its horse a little bit, and we're going to be discussing that as well as some excerpts from a brand new MUFG report that we will be sharing with premium subscribers at the end of this show and beyond. Let's start with the markets themselves. The dollar is down 18 at 101.05. 10-year yields are 365, down 2.75 basis points. The S&P 500 is up 15. The VIX is 1694. Gold is 2565. That's spot, up 6 and change. Silver is 29.96, up 10 cents. Copper is 416 and change, down almost 2 cents. Gold, silver is down again, cracking into that, out of that channel, which makes it more bullish for silver to catch up. WTI up 66 cents at $70 and change. Natural gas, $2.31, up a penny and a half, a penny and three quarters. Bitcoin struggling to go anywhere outside of the $58,000 range. Ethereum, 23.64. Palladium, down half a buck at 10.46, and platinum up $13 at 9.88. Maybe that trade's going to unwind a little bit now. Grains are all up. Soy 10.31 up 2 cents, corn 3.97 up 3 cents, and wheat 5.93 up 10 cents. So call it a wheat-led rally. Moving forward. Oh, there we are. MUFG has a commodity report based on a soft landing. We're going to read that in a second. First, here's the front page. This is our recap from yesterday. We're going to be using that for the basis of our commentary today. Technical report yesterday morning, about 2 hours before the market rocketed, and a report to founders on OPEC, as well as some insights about precious metals. First, let's start with the MUFG outlook. A little bit about MUFG if you're not familiar with them. If you're American, MUFG is the largest financial institution in Japan. MUFG is not a player in bullion, and also a very good bank for analytics terms. So you can trust their macro analysis as being unbiased, as not talking a position, but still a big player. So they may not have Goldman Sachs' name in the West, but in the East, they certainly are that important. And we especially like their work, and we're going to show a lot of it to you today. All right. MUFG says that the U.S. economy is en route towards a soft landing. Inflation is trending towards the Federal Reserve's 2% inflation target. And growth is cooling, but it's not collapsing. Fed Chair Powell's remarks at the Jackson Hole Symposium last month left no room for ambiguity on the direction for policy rates, with the Fed set to deliver the first non-recessionary interest rate cut on 18th of September. By combining a structural modeling approach and market reaction functions around FOMC meetings, we this is their word, parameterize the impact on commodity prices from lower interest rates driven by an accommodative Fed stance, spurred by a soft, not hard, landing. This distinction matters as the impact on commodities from rate cuts is conditional on the cyclical context. Commodities enjoy positive returns during a, quote, good cutting cycle, growth firm, declining inflation, and vice versa. Suffer negative returns during a, quote, bad cutting cycle, growth decelerating, sticky inflation. Now, that's a commodity statement, not a gold statement. I just want to add one thing for you on that last part there. In a soft landing or Goldilocks type landing, all commodities do well, which is very rare to begin with. In a bad cutting cycle, paraphrasing them, growth is decelerating, but inflation is sticky. That is stagflation or anti-Goldilocks. And during anti-Goldilocks, most industrial commodities will do poorly. The exception would be silver, because silver will be acting on its better half, which would be gold. So soft landing, you buy all commodities. Hard landing, you buy gold and silver. They're discussing the soft landing. We're going to get into some details of that in a second. All right, so there's the chart. They believe that the market is set to breach the 3,000 ounce handle in 2025, maybe sooner the way things are going. This is key for me and my in between the line reading abilities. They say, quote, fears where confidence in the US dollar-backed monetary system is challenged alongside the 2024 drivers of gold will catapult bullion higher in 2025. This is a very nice way, a very professional way of saying that half the world is getting off the dollar. Fears where confidence in the US dollar-backed monetary system is challenged. The challenge is coming from the BRICS. The challenge is coming in a month. And although we don't know the measure of the challenge, it will be, based on other evidence, pretty significant, calling for the West to make room for the East in the monetary world. Alongside the 2024 drivers of gold, well, those are the drivers that have been in place because this is coming. So this statement is a very nice way of saying the whole playing field for gold has changed. Now, they may be late to the party, as is every other bank, talking about the reason gold is rallying, but that's their nature. They have to do that. There's a nice chart. We have the full MUFG analysis, including everything you see below, and we'll share our breakdown of it with premium subscribers today. There's the table of contents. It's not just gold. There's a lot going on here. Let's do the recap for today. Yesterday was let's put an hourly chart up so you can kind of follow along here, right? That's 7 a.m. yesterday. It was a big day for gold and silver. Gold hit new all-time highs, both in print and in settlement. It pushed through previous recent highs, gaining momentum around 8:30 yesterday morning. About an hour in, silver followed, gaining momentum even as gold chopped a bit, leaving its industrial cousin, copper, far behind. Silver seemed to remember its true place in the metal hierarchy. The main driver behind all this, the 830 PPI data came in hot. Normally, this would suggest less chance of a bigger rate cut, possibly even no cut at all. It doesn't exactly point to the Fed easing interest rates. Yet about 30 minutes after that data drop, metals markets made their move. Gold and silver picked their direction, and that direction was up. For those who have watched these markets long enough, this was confusing, but as the day went on, it started to make more sense, at least to us. The dollar weakened in an orderly fashion. Bonds, mixed, offering little guidance. Stocks, undecided for the first couple of hours before moving up, albeit much more tepidly compared to gold. Before diving in to the true likely catalyst behind this, it's important to step back and look at the bigger picture. First, we've got the BRICS meeting between October 20th and October 22nd. Second, we've got the US elections November 5th, with all eyes on the presidential race. Uncertainty, we believe, will dominate the political landscape well into the inauguration in January, and that uncertainty seeps into markets, specifically the precious metals markets. Thirdly, and this is more of a catalyst than an event, the pending interest rate cut from the Fed is top of mind. Any rate cut is a signal for Western investors to step into gold, whether through ETFs or gold miners or what have you. But beyond that, and supposedly putting a lid on rallies, there's the seasonality investor cycle, which you hear us talk about a lot here. From September, and this is going to tie it all together for everyone. From September through October or early November, macro funds tend to liquidate some of their portfolios to meet obligations like taxes and bonuses and redemptions, if there are any. Over the last 2 weeks, we have seen some selling by these funds, but the market hasn't broken down at all. Open interest has dropped, but gold has not. This tells us someone is buying, definitely bullion banks. That's their nature. But there's likely other international buyers as well. And we think it's sovereign wealth funds coming out of the BRICS. Now, the catalyst yesterday, counterintuitive catalyst, if you will, was PPI. Now, PPI came in hot, which shouldn't be bullish for precious metals, yet gold rallied, taking off almost immediately. And silver rallied immediately as well, but then silver accelerated when gold paused. It looks like, and this is our take here, it looks like buyers were waiting for a dip after the data, a common tactic in all markets, especially markets that are less liquid from time to time than their bigger cousins. Bigger players will wait for liquidity moments like this to deploy capital, knowing that they'll at least get their contracts and volumes filled, even if the price isn't perfect. Remember, they're macro. They're not worried about the day-to-day movements. The fact that there was little hesitation after the data suggests there's still a lot of money looking to move into gold and growing money moving into silver. This brings us to the next point. Sell season may have been canceled. Now, it's not over yet by any means, but it may have been canceled. There may be too many other factors just vacuuming up the macro discretionary selling. Now, we've hinted at this before, but the fact that gold is up $50 during what should be sell season is telling. Now, those of you who are familiar at the premium level know that I had a little short on, and yes, 2 days ago, the short call spread expired, so I dodged a bullet there. I did not dodge a bullet on the put spread, and I got out of it yesterday, pretty much close to the highs. But small toll to pay when that's a speculative hedge for a much bigger, much more pronounced, much more longer term opinion. All right, which brings us to what is going on. Why is the market not dropping even though they're selling? Why is the market rallying? Why are knives being caught at increasingly higher levels? Bullion banks, we believe, are hurting, and we have no evidence or proof of this. This doesn't mean the banks themselves are in trouble, but their traders are definitely stepping back. Behaviorally, it is obvious what is going on, okay? They're likely waiting for less risky opportunities to sell. In their market-making duties, they sell when someone buys. Well, they're letting it breathe. They're backing off. They're fading away. They're acting like someone who doesn't have a lot of bullets left in their gun. And certainly the commitment of traders' open interest would show that. Not just, by the way, that the bullion banks are at their maximum shorts, but also that their market share compared to producers who normally short is much bigger than it usually is, which suggests, as we've been saying for the last 2 years, let's be fair, is this. There is no organic selling. Producers are not selling. Maybe they've hedged. Maybe they don't want to sell. Who knows? Maybe it's spoken for already. Okay, so the second part of the bullion bank behavior is they are also buying faster. They're not letting it breathe. When the macro discretionary wants to sell, they're quicker to buy it. They're not letting it run, which suggests competition for buying underneath, which suggests some banks are licking their wounds, which also suggests, dare I say it, dissension in the ranks. This is how historically cartel behavior is broken, when it becomes every man for himself. And we may be looking at that. The bigger banks are going to have alternative sources for bullion. The smaller banks will not. The bigger banks will eat them up when this is over. They'll take a hit on the chin and then they'll move forward. Now, moving forward, again, looking ahead, Seasonality is off the table right now. Okay, let's assume that it is affecting the market. You just can't see it because the other drivers are just so much more important. All right. So, what is the simplest explanation? The simplest explanation is PPI wasn't too hot, and money that had been waiting to move into the market finally did. If the Fed doesn't cut rates enough, this is looking forward, then we might see a dip. But for now, the market does not seem to care. That suggests, along with other news, the market is looking towards the BRICS summit for an announcement of significant proportions. Now, we'll be talking more about that in the days to come, probably over the weekend. Specifically, here's the hint. What many have been focused on over the last year, even at the cutting edge, has been that that the BRICS nations have been buying gold. Yes, what they haven't been focused on is the fact that BRICS nations have been buying gold with little regard to price. Their demand has been inelastic. Now, we broke that concept a little bit more than a month ago when we noticed that India's gold buying in tons was the same for almost a year, almost 2 years, almost 3 years, no matter the price. They weren't buying in rupees, they were buying in ounces. How many ounces are we buying? This many, this many. What's the price? I don't care about the price. Everybody is printing to buy gold now. And another post came out about Saudi Arabia also buying gold secretly. The fact of the matter is, the purchases of gold in the East are not price elastic. And not being price elastic at the first level is they want the gold. At the second level, it's they're printing their own money to buy gold no matter the price of gold in dollars. They don't care about the dollar. And that's why the correlations are breaking down. All right. Let's go back to the markets for a second and then stay with us, and we're going to do premium. Okay. Oh, I'm sorry. Let me cover a little news, right? Here we go. Market news. Here's what I'm going to say. I put this up every day, and I rarely read it publicly unless there's something interesting. I read these every day as part of my routine because there's no mention of gold. Bloomberg, FT, CNBC, Bloomberg. These are the most read stories on those services, which means the U.S. citizens are not even paying attention yet. Okay, data on deck, consumer sentiment comes out every week. Always serious, but not going to be extravagantly important right now. Premium MUFG analysis cites extensive evidence to justify their price calls. If you're not a premium subscriber right now, you probably should become one. For this report alone is worth the price of admission. It's about 40 pages long, covers every commodity, and gets into what we call the new model that banks like Goldman and BOA and, JPM hasn't announced theirs yet, and one other bank have said this is how we're going to model gold going in. And this is it. Stay with us, and we're going to go through a little more of this and give some meta insights into the report. Back to the chart for 1 second. Oh, here's a little chart candy for you. Where is that? We are here. Dip, bought, and the breakout on a monthly basis is really from here. On a daily basis, it's really from here. The last time I used this, it was actually accurate. There's a metric that I use to measure moves going higher, and it's based on Fibonacci's, although it's not literally Fibonacci. 2750 is not a problem, and 3000 should not also be a problem. And the downside is, as long as we don't go below 2520 on a weekly close, then the market should, in an orderly fashion, ratchet up to 2750. And if the slope remains as it is right now, then a ratchet up to 3000 should happen in early 2025. Okay, stay with us. I'm going to do the premium version now. All right. The whole report's going to go out later on today. Hey, everyone, let me take a sip here. The whole report's going to go out to everyone later today. Here's the bottom line. It's in the picture up top, but you can see the bottom line there. You can see their price targets. They're really not very excited about silver. And they're saying that dollar strength will keep silver down. Well, if dollar strength is going to go away, then silver is not going to go down. So they're lumping in. See, all the big banks publicly lump in silver with copper because statistically it behaves uh, industrially, right? Right, and because of that, they're not going to. And I say publicly, sincerely, because that's their data, that's their model, right? And that's because it's been manipulated for so many years, tactically becoming, strategically becoming market structure. They're bullish. It's a fascinating report because MUFG is a Japanese bank without really big bullion exposure. They're not bullion dealers. However, ideologically, they're Western, very Western in their mindset. Genuinely, not sneaky or like, not paranoid stuff, right? They're Western. They're like, okay, we're going to change our model. They haven't recommended gold. Why? Well, because gold's denominated in dollars, and everyone's model says the dollar's strong, don't buy gold. Eventually, gold will sell off, and they've been right forever. If bonds are strong, don't buy gold. Eventually, it will sell off, and because of that, they haven't been able to recommend gold as a longer term hold. And while they're proprietary trading, while they're hedge funds, while they're bigger clients may be saying, screw that. We're looking at physical demand. We're looking at de-dollarization. We're looking at all of those secular drivers that are tied with mercantilism, deglobalization, anti-Goldilocks. They're looking at all those things and saying, you got to be nuts to not own gold. They can't put that forward because it contradicts. See, so much of these banks' models are based on currencies because currencies are king when it comes to the macro, what do you call it, tides that give the headwinds and tailwinds. I'm mixing metaphors here, for your individual assets. So for them to say buy gold despite the dollar being strong is to screw with their whole model. And I say this, in sympathy. So BOA changed their model. Okay. Goldman Sachs changed their model. Citi, that's the other bank. Citibank changed their model. We have a new model. And the new model says, I love it. The new model says physical demands, this, and this. And then the last thing, every one of their models says, and the Fed's going to ease, so you may as well buy it. So they're still using the weak dollar buy gold, but now it's a catalyst to the fundamentals. So gold's rallied $500, $700, depending on where you measure, and they haven't told their people to buy largely. And now they're telling them to buy. So you're right to be skeptical and say, oh, here we go. Here we go. Bag holding. And there will be bag holding. There will be bag holding. But it won't be Bitcoin bag holding. It won't be 5 million longs that are going to sell to 2 million American saps that are going to buy. It's going to be 5 million longs. Some of them are going to sell because most of them look at the bigger picture, and 2 million American saps that will buy and possibly make money this time. And I'm not talking my position. I'm not selling you anything here other than subscriptions, but you've already purchased that. So you're not susceptible to sales pitches. The public makes money when the demand is grassroots, and demand has been grassroots forever. If the U.S. investor is going to be a bag holder, well, in order for the U.S. investor to be a bag holder 5 years from now, not over the next 6 months, the deficit has to go away, right? Right? The spending has to stop. that's not going to happen. It won't happen until we get Arthur Burns. It won't happen until we get Volcker after Burns. It's just not going to happen. All right, so what did I write here? About MUFG, Western Bank, not a bullion bank. This is a preview of their buy season. Oh, yeah. Look, I think MUFG is leaking their buy season thesis. Now, it's not their thesis. It'll be everyone's. When buy season comes, you're going to come out and say in November, buy gold because of this. Buy silver because of this. Okay? I think I just babbled on about this here. All right? Now, what's the other thing I wanted to mention? I don't know. It probably wasn't important. But there you have it. So, the secular thesis about gold has been correct for the last 3 years. Now we get into how big of an effect will the West have if they throw in finally to get gold higher? And secondarily, if the Fed disappoints on their rate cut, and it sounds to me like disappointing from a stock point of view is 25 basis points. Well, if the Fed disappoints on a rate cut to 25 basis points, how big of a hit will gold take? Well, I don't think a big hit. I'm not sure, but look at what happened. PPI was hot. Gold went up. This isn't about news being good or bad and correlating. This is about news being moments where people get an opportunity to deploy capital. I'm Vince. Have a great day. This report will be out later on today. I'm not even going to break it down because, they have this wonky style. When you look at it the first time, you're like, that's so busy. But then it kind of like breaks down nice. It's kind of like the chart, a little bit of a graphic. Anyway, I'll throw it up for you. See what I'm talking about. I've shown their stuff before, and I have broken their stuff down. But here, take a look. Right, nice graphic. This is written for retail, but it's not shit. Executive summary. I pretty much read the executive summary. Right. Look, I mean, very, very busy looking. But if you read it in sections like this is the thesis. What do rate cuts do to commodities? And by the way, I'll tell you the thesis. Forget the thesis. If it's a soft landing, you buy all commodities. If it's a hard landing, you buy gold and some silver. That's it. That's the thesis. There's the grid, very, very much like it almost looks like a CNBC or an ESPN graphic visual, very good chart. The charts themselves are very good and very consistent with what they're talking about. Soft landing. There's your data. But I know I wanted to say, guys, this is what Hartnett's going to fucking write. This is what Hartnett's going to write. If it's a soft landing, buy this. If it's a hard landing, buy gold. This is what Hartnett's going to write. That's what I wanted to say. It's almost like he wrote this because it's got the statistics, it's got the grids, it's got the historical dimension. It's like a Hartnett report. Whoever their economist is, I'm going to take note of his name. All right. See you later.